This video is going to help you understand what a Fibonacci retracement tool is and how you can use it to identify price reversal points in order to get those sniper entries with a very tight stop loss. Have you ever looked at the chart and see that the market is pushing to the upside, but the minute you enter, it immediately reverses and takes you out for a loss, and then it continues to push to the upside? In this video, you're going to learn a tool that will help you take advantage of such movements in order to always be on the right side of the market and enter at the best time possible. Because yes, we can identify the market is pushing to the upside, it's a buy, but you can't just jump into the trade without having a specific criteria that you need to follow. You need to have a strong understanding of the nature of price in order to understand what the next movement will be, right? What's going on, fishers? Welcome back to our forex trading for beginners series. Now it's the first time landing on our channel, please make sure to smash that subscribe button, and if you find value in this video, please give it a thumbs up and share it with someone you know who's also into trading. So in today's video, I'll be answering the question how to use the Fibonacci retracement tool. Just to give you guys an explanation of what the Fibonacci retracement tool is, it was actually named after a person, a mathematician from way back. Leonardo Fibonacci is a mathematician that came up with the ratio of numbers that now we can use to identify a retracement, right? So the difference between a retracement and a reversal is that a reversal is a complete change of direction, right? So if we are looking for buys, and if it's a reversal, now we are changing into a new trend, which is a sell, right? We are getting into a bearish market. Now a retracement therefore is just it's not necessarily a reversal, it's just a small movement that's against the overall trend, but it will soon continue with the trend. So as I did mention in the previous video that the market moves in phases. We have the impulsive phase followed by the correction and then the next impulsive phase, right? So we use the Fibonacci retracement tool in order to understand how long this correction will take, right? So there's a specific level that we look at in order to understand where the correction will end, right? So let me just take it out. This is our Fibonacci retracement tool, and before I plot it, just to explain how we are going to plot it is, as you can see, like I did mention, this is the impulsive leg, right? It starts here up until here, and then from here this is the correction, right? So how we are going to plot our Fibonacci tool is going to be from here at the beginning of the impulse all the way to where the impulse ended before the correction started, because we want to capitalize on the next impulsive move to the upside, right? So how we are going to use the Fibonacci, this is the Fibonacci retracement tool right here. We are going to start it from the beginning of the impulse, and then as I extend it like this, automatically levels present themselves, right? So I'm just going to extend it up until the end of the impulse, and then I'm just going to extend it all the way to the side like this, so that these levels can be clearly seen. So from what we are seeing here, this is our impulsive leg, this is our impulsive leg, and then this is our correction, and then we want to capitalize in this impulsive leg to the upside, sorry. So how we use our Fibonacci retracement tool, as you saw, automatically these levels present themselves, right? So initially it has a lot of levels, even 0.318 or something. There are so many levels that present themselves, but for the purpose of catching those high probability trades, we are only going to focus on our golden zone, which is these two levels that I left here, which is our 0.50 and our 0.618, right? So this is our area of value right here. This is where we are looking to see rejections. So if we see a rejection in this zone, that's how we are going to be capitalizing on the next move, because that gives us an indication that the correction has now reached the end. We are now looking to move into the impulsive phase. So how we execute our trades is here when we see those rejections, and then our stop loss becomes just below our 61.8, because if it breaks below our 61.8, let me show you, if it breaks below here, then this means that this whole move now is no longer a retracement, but it's a reversal. So we are not expecting price to break below our 61.8 here, or 0.618, sorry. If it breaks below here, this is no longer a retracement, but it's now a reversal. We are now looking for sells. But as long as we're seeing rejections in this zone here, that gives us a clear picture of, that gives us an indication that we are still continuing to the upside. This is just a correction, right? So this helps us to enter the market at a much better price, right? Because someone who entered here, you don't know where to place your stop loss, right? And even if you know, it's gonna have to be a very, very, very big stop loss, and not a lot of traders can afford those big losses, right? Because you don't know which trade is gonna go in your favor. So the least you can do is stick to a small risk percentage, right? So how we capitalize on this is we enter here. As we see those rejections, our stop loss just below the 61.8, and our first target will be here at the 0% level, right? Okay, so guys, now we are looking at gold. This is the 1 hour time frame, and just by looking at this chart, just understanding the nature of price, you can see this is our impulsive phase, this is the correction, this is the impulse, right? Again, this is the correction, the impulse, this is the correction right here, and then this was just a bigger structure. Is we are looking to capitalize on these reversals. That's where we are looking to capitalize on our trades. Not entering here, but we are entering lower in order to capitalize more and bank a lot of profits, right? So if I just pull it out, like I did say, I'm gonna start it from here, the beginning of the impulse, and I'm gonna end it all the way to where the impulse ended to start the correction. So I started there, and then I'm extending it up until here. As you can see, the rejections that we are looking for are at our area of value, this zone right here. This is where we are looking for those rejections. So immediately as this candlestick rejected here, that's when we would have executed our buy trade, stop loss just below the 61.8, and then our first target being right here. As you can see, this is a beautiful 3%. This is a beautiful 3% trade, right? And then again, let's remove this. And again this one, right? Again, also this becomes the impulsive leg. This is the correction. We want to capitalize on this impulsive push to the upside, right? So how we are going to go about that is take out our Fibonacci, start it here at the beginning of the impulse all the way to where the impulse ended, and then I'm just going to extend it, mark out my area of value. As you can see, even if I extend it,
it now acts as support and resistance, right? So guys, these levels help us identify support and resistance levels, right? We use these levels as support and resistance because I can see here it was previously resistance, then price went down and then it broke all the way to the upside, came back to test this. This was previous resistance, it now becomes a support. So as soon as it rejects here, we enter our buy trade again, right? After this candlestick close, we enter our buy trade, stop loss just below, then target here. Or you could use pending orders, right? Meaning that you can just place your buy stop somewhere in this zone so that whenever price gets to that zone and then it activates your order. Alright, but the downside of this method is that if price just shoots all the way to the downside, it will automatically activate your order even though it doesn't reject in this level. So for us to take trades, we wait for a rejection, right? So hence I could have waited for this candlestick to close and then entered my buy stop loss just below the 61.8, my target here at the 2.82%, right? And then again, if you can check here, this is our impulsive leg, then price retraced backwards, right? And then it gave us rejections, right? As you can see by looking at this candlestick here, they are giving us a signal that the market is rejecting. As you can see, these are rejections. So we're going to take out our Fibonacci to see where are those rejections taking place, and if it at our area of value, we're going to be taking the trade, right? So let me take out my Fibonacci. Can start it from here at the beginning of the impulse, because after this it's just an impulsive leg, and then all the way to where the impulse ended, and then I'm just gonna extend it like this. Can you see these rejections are still happening at our area of value? And as I extend it like this, we can say this was what our resistance, and then it broke all the way to the upside, came back to test and creating a new support level, right? So these levels help us identify those key support and resistance levels. So by making use of the Fibonacci, we are able to capitalize on such trade. And how we were gonna capitalize on this trade in particular, immediately after these rejections, we enter our trade, stop loss just below the 61.8, target all the way there. As you can see, we did reach our target even though we didn't hit it like straight, but eventually price did get to our target, right? So guys, how we use the Fibonacci retracement tool is we use it as a layer, right? So now that you understand how to plot it, if we wanted to capitalize on this specific buy, yes, our Fibonacci confirms that we are continuing to the upside. As you can see, it rejected at our zone here. This is our area of value. It rejected here, right? So but you can't just use the Fibonacci on its own. You need to use it as a layer, right? So you need to add also other layers that confirm this buy that you are looking at, right? You can't just enter your buy here because of one confirmation. You need layers that confirm what you are talking about, right? So another layer that we can add here, just by using our zone here, like I did say, the Fibonacci retracement tool helps us to identify support and resistance levels, right? So if I can just extend this right here, can you see the market has been playing in this zone for a long period of time, right? This here, it was support, and then it broke and then created resistance. It was just resistance and then resistance, and then again resistance. Then price went down until it eventually broke all the way to the upside, right? So after it broke, it came back now to test this as a new support levels, because old resistance becomes new support. So here it's support. We are at a level of support. We are looking to take price higher. So that's another confirmation that confirms this trade that we are looking at. Another confirmation that we look at, like I did say, using the Fibonacci retracement tool, we want rejections, right? And when price rejects, it means that there is no enough momentum to continue to that direction. It wants to reverse, right? So as you can see by looking at this candlestick here, it's a beautiful rejection, right? It's a rejection, more like a hammer, where price tried to push to the downside, but there was not enough momentum, hence it closed with a very small body and left this big wick, which shows us that there is less momentum to the downside and more momentum to the upside. That's another confirmation also. So adding another layer, guys, as I did mention that we need layers, right? I'll add another layer. I can use my trend line here to say that this was my first touch, as I'm identifying this as a new trend, which is a buy, right? We are going to the upside. So this, my trend line also must support the trend that I'm looking at. So if I'm looking at buys, I must get an uptrend from my trend line. So I'm gonna start it here because this is our lowest point. This will become our second touch. Then this will be our third touch. As you can see, this was our first touch, second touch, third touch. It also confirms the trend that we are in, because remember we were pushing to the downside, but after here we changed into a bullish market, right? So even our trend line confirms that we are in a bullish market, because the slope of our trend line is positive, right? So we are in an uptrend, hence buying there would have made a lot of sense.
And that's basically it for today's episode. I hope you guys learned a lot from it. If you find this video informative, please give it a thumbs up. Make sure to hit that like and subscribe button, share it with your friends and family so they also learn more about forex trading. My name is Fishbone Mazibuko, and this is Market Fishers.